Hey everyone, this is Tim Dial, and I'm the managing broker for Extreme Lending and powered by Nexa Mortgage. And I wanted to put this video together here to go over a program that I just recently got certified on. I'm super excited about it. I'm so excited about it, in fact, that I'm in the process of refinancing my own mortgage into this program. It's called the All-in-One Loan and and it's just incredible. It's going to allow me to pay off my mortgage in about a third the time, I believe, from everything that I'm seeing and from the numbers that I'm running and everything. And it can do that for just about anyone else as well. And there are a lot of reasons for that, but the all-in-one loan, I think, is the most incredible product out there. It's a lot less reliant on the interest rate, and I'm going to get into some of that here on this short video. Well, this video will be a little bit longer than most videos I do, and that's simply because I want to get into uh, a pretty good description of the program and what it does and explain it in pretty good detail so that people can understand it, because it is different than anything that most people have seen before. Everyone's familiar with a 30-year amortized mortgage. The all-in-one loan really sort of um, recalculates and refigures how we can do mortgages and why it is why there is a much better alternative than a 30-year amortized mortgage. So the first thing I want to do right now is share my screen with you and go through a little bit of a presentation here, which I think you're going to see what makes this so good. So here, you should be able to see my screen now. Um, and this is the all-in-one loan. And just to give you a little bit of information on the starting slide, um, this loan allows you to spend less on your housing debt. You own real estate a lot sooner. What I mean by that is people believe they own the real estate when they purchase it and they get a mortgage on it. But when I say own it, meaning you own it outright, you don't have a mortgage anymore. And it allows you to do that much sooner. And additionally, as a result, you end up paying a lot less interest over that period of time. So it also gives you access to your equity whenever you need it. So if you had some sort of a big problem or something, something comes up and you need to pull money out of the equity, you always have access to the equity if you need it. And then additionally, you can also fund other goals. You can use the equity to buy or for the down payment to buy an investment property, or you have kids who are old enough to go to college and you need to maybe pay for some of their college or something like that. You have access to the equity to do so. You need to replace your air conditioning or something, you have access to the equity to do so if you need it. Those are some of the nice things about the all-in-one loan. You always have access to your equity if you need it. So just getting into this a little bit, the all-in-one loan is a privately secured residential home mortgage product. It was developed by CMG Financial, CMG Home Loans in 2005. So bizarre that I'd never heard of it before when it's been around for that long. But part of that's because I hadn't been with Nexa Mortgage until the beginning of 2023. So Nexa Mortgage is the largest broker in the country. We do have access to the CMG products as a result, and and I had to go through a certification process to become certified on the all-in-one loan, so that I can go out there and utilize it for my clients, which I have done. I'm certified mortgage professional in the all-in-one loan, and my name is Timothy Dial, managing broker. And there's my contact information here at the bottom. The all-in-one loan can be used for single-family residences, condos, or 2 to 4 unit multifamily properties. It can be used for purchases or refinances, rate and term or cash out. Most of the time, if you're doing it as a refinance, most of the time you're going to do it as a cash out, even if you're not necessarily pulling cash out. And the reason I say that is because you want access to the equity. And so just to give you an example, let's say let's say you have 40% equity in your house. You still want to in my opinion, you'd want to do it as an 80% loan to value ratio so that you have access to that extra 20% equity if you ever need it. So that's what I'm doing, and that's what I would recommend most people do. They'll actually let you go up to 90%, but I recommend just going up to 80%. That way you're not having to pay any kind of mortgage insurance. So that's my recommendation on that. And then also, it can be used the types of homes, primary residence, second homes, or investment properties. Most of the time, it's going to be a primary residence, but they do give you the other options as well. And the maximum loan amount is 3 million. Not many people are going to be up there in that kind of category anyway. So that's a little bit about how that whole thing works. Why reimagine the mortgage? So the main reason is because a lot of people don't realize it, but when you get a 30-year amortized mortgage, a 30-year amortization pays almost all interest on the front end. They front load the interest on it. You won't pay your home off until 30 years down the road because people just pay the minimum on their mortgage all the time. People don't want to pay the extra. Like, let's say you wanted to pay $500 extra toward the principal during 1 month. People don't want to do that because there's no way to pull that $500 back out, right? With the all-in-one loan, you always have access to it because it's in your equity, and you always have access to your equity, right? And so, so it's a lot different in the way you look at it. Um, but banks love 30-year amortizations because they make so much money on them, and we're going to get into some of those details here in a little bit. Borrowing costs money, rates drive perceived affordability. So what I mean by that is when you look at it, somebody gets a 3.5% interest rate, or somebody gets even a 6% interest rate. Those seem like pretty low interest rates when you think about it, compared to like a 20% interest rate on like a credit card or something like that. Um, the the interest rates seem really low, but if you actually calculate how much interest you're paying, if you get a 6% interest rate during the first 8 years that you are owing on that mortgage and you're making those payments, during those first 8 years, you will pay over 300% interest. And it's just incredible because you're paying almost all interest on the front end. And so that's why the all-in-one loan is so much better, because they calculate the interest differently. What's happening is whenever you get deposits, your deposits are going into the all-in-one account. It pays down your mortgage temporarily, and then you're paying less interest because they calculate it daily. So every day that your mortgage balance is lower, you're paying less interest because you're paying interest on what you owe rather than all this front loaded interest on a 30-year amortization. And what they do is they calculate it daily, but then on the 21st of every month is when they charge it to you, and then it comes off of whatever your equity is, right? So as you receive deposits in, the end of the month, you pay your bills out of it. Whatever's left over is the extra equity that you have available because you're going to get more deposits in than what you're paying out in most cases. And as a matter of fact, they've kind of figured this out, and over almost anybody who does an all-in-one loan during the first 4 to 5 years, they're going to receive deposits that total more than the actual total amount of the mortgage. So if you receive, let's say you receive deposits of $100,000 a year, well, in 3 years, you've received deposits of $300,000. If you only owed $300,000 on the house, you've received deposits that are more than the total amount of your mortgage. And you're also making payments, right? So, it's not like you're going to pay off the mortgage in 3 years, but because you're receiving those deposits, it's paying down your mortgage. You're paying less interest because you're paying interest only on your balance every day. And then over time, you're paying it off a lot faster. Most people are going to pay off the all-in-one loan in 10 to 12 to 14 years, somewhere in that ballpark, rather than having this 30-year amortization. And it's going to save, in most cases, it's going to save 200, 300, sometimes even $400,000 in interest charges, depending on how big your mortgage is. So that's a little bit about how that works. 90% of loans are 30-year forward amortizing. That means, 90% of loans out there are 30-year amortizations, because people don't want to lock themselves into a 15-year mortgage with that high payment. Because what if something happens? What if something happens? They lose a job temporarily or something, or they have a big expense come up. They don't have access to those funds anymore. So they don't want to do a 15-year amortization. Um, so that's how that works. Housing debt is at $12.2 trillion. So, people, tons of people owe on their homes. 50% of households are not saving enough to fund their current standard of living during their retirement years. 30-year amortization is a big part of that. What most people do is they will buy a house, live in it for, 3 to 8 years, and then at some point during that period of time, they'll sell it and buy a different home that better meets their needs. They start the 30-year amortization all over again. So they're never getting it paid off. They're paying almost all interest all the time because they keep doing this process. Just as an example, my parents recently paid their home off. My dad is 82 years old. He didn't pay his home off until he was 80, right? If he had had the all-in-one loan, he probably could have paid it off when he was 60 or 65. And then he would have had like 15 years of better retirement years because of not having that mortgage payment during that period of time. So, it's just, it's an incredible thing. So, anyway, for most people, 42% of their debt is the mortgage, and the other 58% is everything else combined that they're paying on. That would be like cell phone bills, electricity, gas. Um, if you have credit card bills and things like that, things you purchase, groceries, all that kind of stuff makes up the other 58%. So mortgages make up a huge portion. Just think if you get it paid off early and you could get rid of that 42% and have that available during your retirement years. Pros of a 30-year mortgage is that, 30-year amortized mortgage is that there's a low down payment. So it helps first-time buyers get into a home. And I still recommend that for first-time buyers. You're not going to do an all-in-one loan as a first-time buyer most of the time because you're not going to have a big enough down payment to do it. So it still helps people get into a first home. But the nice thing is once you get into that first home and you start, making payments, the equity grows because the house becomes more valuable over time. Once you have enough equity, then you can refinance to an all-in-one loan and get it paid off a lot faster. But anyway, the pros, like I said, helps first-time buyers. Familiarity developed in the 1930s, hasn't really changed since. Banks love it, like I said, because they make a ton of money off the interest. Readily available in many different forms. There's FHA, there's VA, there's USDA, there's conventional, all these different programs available. And there used to be a lot of subprime available, but that's not really around much anymore. But anyway, it's a readily available commodity that people are very familiar with, and the approval process is not that difficult. Payment dependability, you know what the payment's going to be every month. It's a fixed payment. The only thing that could change that is if your taxes on the house go up or your insurance goes up or something like that, then your payment could go up a little bit because you usually have those things built into your mortgage payment. So cons, it's very slow, takes decades to repay. It's very inefficient. Interest costs are paid primarily first within the repayment schedule. So like I said, you're paying almost all interest on the front end. Inefficient. Rigid, can't take money back out. So that's another big factor. One of the things nice about the all-in-one loan is that even though you have these deposits go in and they're paying the mortgage down, you still have all this equity available whenever you need it. You still have checks, you still have Visa card associated with it or debit card. So you have access to those funds all the time whenever you need them. And it's also expensive. Even with low interest rates, mortgages cost a huge amount of interest over time. And usually, like I said, first 8 years, over 300%. If you look at the entire 30-year picture, most people are going to be paying over 100% interest, even over 30 years. And that's considering during those late years, you're paying mostly principal. So that's a little bit about how that works. This gives you a little bit better picture of the mortgage payment structure on a 30-year loan. If you look here, this yellow is interest. So you're paying almost all interest on the front end. Get up to year 15 and you're here, right? You're paying more principal than interest by year 15, but you still haven't paid back 50%. You don't get to 50% in year 20 until year 21, which is right here. So year 21, you've paid back about 50% of your original principal at that point. With the all-in-one loan, you'll have it paid off in 10 to 14 years, most likely, and you won't be dealing with this kind of a schedule. So rate versus cost. This is the example that I talked about. If you were doing current rates are right around 6%, fully amortized. Now, depending on when you see this, they may be lower than that by now. I'm just saying that at the time I'm making this video, rates are around 6%. 6% interest rate over the full 30-year amortization. If you paid your payments on time for 30 years, you would pay 116% interest on that 6% interest rate. So they make it sound like the interest rate's pretty low, but in reality, you're paying mostly interest. So, and that's $116,000 in interest on every 100,000 you borrow. So the difference with the all-in-one loan, or what you can achieve with it, is that you're going to pay the balance down 2 to 4 times faster without a change in your budget, because of the way interest rates are calculated, and because those deposits are going to be paying your principal down, and you're going to be paying interest on less principal all the time. Reduces monthly and lifetime payments by tens of thousands of dollars without depending on lower rates, and it provides access to your home equity anytime you need it. Something comes up, you lose your job, takes you 3 months to get another job, you're not worried about going into foreclosure or something like that, because your equity is covering you during that period of time. You don't have to worry about it while you're looking for that other job. You have some big expense come up, your roof suffers hail damage. A lot of insurance companies are charging $3,000 to $5,000 deductible on hail damage now. So you don't have to pull $5,000 out of your bank account. It just comes off your equity. You start paying the equity back down again. And so it really puts people into a much better frame of mind, a much better way of doing it, because you're not panicking about every expense that comes down the pike. It's also great for anybody who has like a variable income. Like if you're on some sort of commission income or something like that, you may have one really good month and then maybe 2 or 3 slow months. During those slow months, you don't have to worry that you're not be able to pay your bills. And then you have a really good month again, and boom, you're back to where you were. But you're not going to have this yo-yo sort of thing going on, to where during those lean months, you're not worried about, okay, how am I going to pay my cell phone bill, or how am I going to pay my electric bill, or how am I going to pay my mortgage? You don't have to worry about that during those slower times. So that's a little bit about the difference there. So this gives you a little bit of information about the all-in-one loan and its structure, right? With a mortgage, you have your principal, and then how much you owe on the house. Basically, as you get those deposits in, that principal comes down. And then as you have bills come available, the principal goes back up as you're paying those bills. And that's because it combines your mortgage with a checking account. And you still have your 24/7 ATM access, Visa access. You still have personal checks. You still have your online banking, mobile banking, and client services just like normal. But it combines the accounts. So that way, let's say you're putting most of what you do during the month on a credit card. Any expenses you have, you're putting on a credit card. At the end of the month, you just have your all-in-one account pay that credit card off at the end of the month. You're not paying any interest on the credit card at any point in time. And then you're still paying less interest on the house, because your deposits are paying the principal down. You're paying interest on the principal. And at the end of the month, you pay the credit card off. Your balance on the principal goes back up at that point. So more deposits come in, principal goes back down, you're paying less interest, right? So that's kind of the way it works. Checking accounts, the birthplace of net worth, because they help store income dollars once it is received. The problem with a traditional checking account is that your money sits there until it's time to pay bills, and it doesn't do anything for you, right? With the all-in-one loan, it's paying your principal down instead of just sitting there. So you're paying less interest on the principal. But in a traditional account, it just sits there. The bank uses your money until you make payments on whatever bills you have, because checking accounts traditionally don't receive much interest at all, if they do receive any interest at all. They're very low interest, if any interest at all. So, so that's one thing. You're basically, with a traditional checking account, your money's sitting there not doing anything for you. With an all-in-one loan, it's paying your principal down temporarily. And that way you're paying less interest on the principal. And the way they do that is what's called a sweep. So once a month, usually on the 21st of the month, they'll do a sweep. And what's happening is during the month, actually, let me get to the next slide. I think it's a little bit better. Um, yeah, so this gives you a little bit of information here, the way the interest is calculated. Every night they look at what your principal balance is. They calculate that by your interest rate divided by 365 days. And that is your daily interest. Well, they don't take that out of your account at that point. They just calculate how much your daily interest is. They add all of those days together until you hit the 21st of the month. And then on the 21st of the month, they do a sweep and they take the interest that you have accrued during that month and they take that out of your equity. And so that allows you to keep that balance low for longer because they're not taking it out every month. They're not taking it out until the 21st. So your money keeps working hard for you for that additional 20 days. Additionally, if you're using a credit card, you can keep that money working hard for you and not pay that credit card off until the credit card's due date. So same sort of situation. So anyway, that's a little bit about how that works. So, the all-in-one loan, money, your equity, money not needed for regular expenses, money not spent on traditional mortgage payments, bills and expenses, spending. So, this is kind of what we were just talking about, right? Your equity is growing faster because you're paying less interest on the principal because your principal balance is lower all the time. And so your equity is growing at a faster rate. And then the other nice thing is too, that every month you get to see that equity grow. So if your equity isn't growing, you're like, okay, what am I doing? What expenses am I making that are causing me to not grow my equity as fast as I should? I have to be spending more than I should be spending. So it allows you to look at your expenses and say, okay, well, this month I ate out too much. I spent $300 on restaurants, and that's why my equity didn't grow the way I thought it would. It allows you to really kind of take a look inside your numbers a little bit better. And if your equity's not growing the way you thought it should, you can really say, okay, where do I need to bear down so that my equity grows the way I want it to? And allows you to manage your finances a little bit better. But the big thing is you're not paying interest on your credit cards ever. You're not having these credit cards grow like crazy during lean times because your equity's covering it. And then you get to see what happens with your equity and say, okay, I need to spend less money. This is the way the all-in-one loan works. I want to get into this a little bit. During the first 10 years, your approved credit limit stays the same, right? It stays the same the first 10 years. The next 20 years, they start reducing the amount you have available by 1/240th. So that way, by year 30, you have paid it off no matter what. Now, for most people, this last 20 years isn't going to even matter because most people are going to have it paid off, within, like I said, 10 to 14 years. So it's not going to matter. This last 20 years isn't going to really make a difference. But they reduce it because they want it to be paid off in 30 years no matter what, because it's the way it works. But like I said, for most customers, the whole idea is this is going to be paid off much faster. And then once it's paid off faster, then you're just going to have all this equity available for the rest of the time until you get to that 30 years. Oh, one thing about it though is when you do pay it off, if you do pay it off way early like that, you have two choices. You could either go ahead and close the account at that point if you want to, or you could keep it open if you want to continue to have access to the equity. So those are options that you have available. And this is just another chart that shows you, year 15, 75% available, year 20 stuff, 50% of the equity available, and year 25 stuff, 25% of the equity available. But like I said, usually by this year 15, you've already paid it off. This is an example of the way some people use or utilize the account, right? So this gives you an idea of how much your principal is in the early years. And as you're paying that principal down and you're gaining equity, then something comes up and you have college tuition costs. So your principal goes back up because you take money out of the equity to pay for college tuition. Then you start paying it down again, you get it all the way paid down, and you've paid it off within this like 12 12 or 13 year period of time, it looks like, paid it off. So it's been paid off. You keep it at zero. You don't close the account. You keep it at zero, and then something comes up. Hey, you know what? There's a rental property I want to buy. So you use funds to buy that rental property, and the balance goes back up. And then you start paying it down again. You pay it off again. Then something happens and medical expenses come up. You pay the medical expenses off, start paying it down again. So this is just one example of the way some people can use this account over time, depending on what your needs are. Um, the all-in-one loan is a consolidated banking platform. Prior to closing, you will be contacted by a QA professional, questions and answer professional, and they're going to confirm your expectations, answer any questions you may have, make sure you understand everything completely. And that's prior to closing. It's usually just before closing. And then after you close, usually within 48 to 72 hours after closing, you're going to get a what to expect packet, and it's going to have information about the account and setup process. And then within 2 to 4 weeks after closing, then you're going to receive your banking access features, your ATM Visa cards, your routing numbers, account numbers, all that kind of stuff, checks, online portal credentials, mobile app. You're going to get that all 2 to 4 weeks after closing. And that's at the point where you'll also be able to set up your direct deposits and things like that. Because you want all your deposits going into that account to pay down that mortgage. That's what's going to save you the money. And then you still have that equity available to pay off your bills. So that's kind of how that whole process works. Want to get in a little bit about the credit rate terms here. So the way this works, it's considered as a first lien, but it's considered as a 30-year draw open-end mortgage or home equity line of credit with an integrated sweep checking account. That's the way they look at it. So it is like a first position home equity line of credit with a checking account because you have checks and stuff like that to draw on it. And it does have that sweep feature once a month, like we talked about. It is a manually underwritten type of loan following Fannie Mae state and federal standards. You have to have at least a 10% 10% equity or 10% line. You're not going to worry about that. Most people, like I said, I recommend having at least 20%. So you'll be above that 10% all the time. And then debt to income ratio, that they allow you to go up to about 43% on the debt to income ratio. But also keep in mind too that you can use this account if you have the equity. You can use this account to pay debts off to make sure you're under that 43% if you need to. So those are some of the possibilities there. It does say greater than 80% LTV requires 40% maximum debt ratio. I recommend staying under that 80%, so then you're not going to have to worry about it. You're not going to have mortgage insurance, et cetera. So anyway, that's some of what I want to talk about there. One other thing they don't talk about on this slide is that they do require credit to be pretty good. So, the credit score requirement is a 700 or better if you're at 80% loan to value, which I think there might be a slide in here that actually gets to that. So I'll get to that in a minute. But yeah, 700 credit score. I actually have a client right now who is selling his house, which I helped him finance to buy. He's selling his house and he's buying something else. He cannot use the all-in-one loan to buy this other house because his credit score isn't high enough. And his reason his credit score isn't high enough is because he has a lot of revolving debt. So what we're going to do is we're going to use the equity in the property when he sells his house to pay off that revolving debt. He's going to use part of it as a down payment on the new house. And then within the next 3 to 6 months, his credit score will go above that 700 because of paying off all that debt. Once he's above that 700, within the next year, we can probably refinance him to the all-in-one loan, which is going to be the thing that we will likely do. He just can't do it right now because his credit score isn't high enough. So that's what we're going to do. Probably within the next year, we'll have him on the all-in-one loan. Also, the way this works when it comes to rate is not the most important thing because they calculate interest differently. It's not a 30-year amortization. So the interest rate on this is usually going to be a little bit higher than the interest rate on a 30-year amortized loan, but you're still paying less interest because you are paying interest on a lower balance pretty much all the time. So that's the way it works. they base it on margins and constant maturity treasury, which you can look up. You can look up online whenever you want to. Right now, it's higher than 2.1, but historical average is 2.1. The nice thing about this loan too is for people like, let's say, if somebody is buying right now or somebody's refinancing right now at 6% is what the normal rate is, then over the next several months to possibly a year or two, that rate on this product is going to keep coming down because it's based on this constant maturity treasury. So as that constant maturity treasury comes down, the rate on this program is also going to come down. So people buying right now are getting a fixed rate interest, and they're stuck at that 6% unless they refinance later. That's not the case with this. It's going to keep coming down. But like I said, interest isn't the most important thing, the interest rate. What's more important is the way interest is calculated. That's where people save the money. When it comes to margins, they range from 2.5 to 4. They start at the 4% margin, but you can pay extra out of your equity to bring that down to 2.5. And I recommend for most people to bring that 4 down to 3. You can pay a little extra, bring it down to 3%. That gives you a little bit of interest rate over the life of it, and it's going to save you a little bit of extra money. So that's how that works. This is what I was just talking about as far as credit score requirements. I recommend most people be in this 80% loan to value ratio. And then that's going to mean that you need a 700 credit score or better. And that doesn't matter if it's a purchase or rate term refinance or if it's a cash out refinance. Most people are going to fall into this cash out refinance because if you set it at 80% and you only owe 60%, they count that as cash out, even if you don't pull that cash out at that time. So, so that's how that works. Additionally, it is good for single family residences, condos, multifamily, 2 to 4 unit properties. It can be used for any of those. And once again, 80% loan to value, 700 or better credit score. This is a little example for something they have available called the Interactive Comparison Simulator. The Interactive Comparison Simulator I actually have available on my website, which I'll get into in a minute, that it looks pretty much like this, except it's in a different color format. But this is kind of an example, right? They started off with a $640,000 loan. The total interest they paid on it was $468,000. They made 189 payments and they paid it off in 15.8 years. Traditional mortgage, they would have paid $741,000 and it would have taken them 360 payments or 30 years to pay it off. So as you can see, the total saved was $272,000 here compared to what it would have been on a traditional 30-year. Now these results differ depending on the person, depends on how much deposits you have coming in and how much expenses you have going out. The more deposits and the less expenses, the faster you're going to pay it off. Simple as that. So that's how that works. But the interactive simulator is available so that people can get an idea of what it would look like for them. And you can actually put your deposits in there, put in there about what you think your expenses are, and it'll do this calculation for you. This is one of the great things about this product too, and why it's obvious that it's really wonderful for a lot of people, is that because of the people who have utilized this product, 9 out of 10 will recommend the product to 3 or more people they know. That's how strongly they feel about it. I've actually had loan officers tell me, "Oh, I don't think I want to sell this product because, if I get somebody on this loan, they'll never want to refinance again." And and for me, it's like, okay, number one, it's better for them. So you're going to be like a hero to them. Number two, they're going to recommend it to 3 or more people because it's so good. So why wouldn't you want that? I spend a lot of money on marketing, but if I can get people to love this product and to love what I did for them, and they go out and recommend it to 3 or more people they know, that's free marketing, right? And that's better marketing because they trust those people who are referring to me. So that's one of the things I love most about this program is that if 9 out of 10 people are recommending it to 3 or more people, then it's got to be great. Otherwise, that would not happen, right? This is just showing you a little bit about where to find the all-in-one simulator on my website. My website's extremelending.com. And if you go to resources, the first option is the all-in-one simulator. You go to the all-in-one simulator and it's going to pull this up for you. And as you can see here, I've gone ahead and hit the select button whenever I pulled this up, and it gives you these different options. I wanted to go over this really quickly because whenever you do a simulation, it's going to give you a code. The code will show up right here. And when it gives you that code, you want to write it down somewhere or save it somewhere, because you can go back into the simulator at any point in time. And if you enter that code, it's going to pull your simulation back up. You can also provide that code to me and I can pull your simulation up. And that way I get to see your numbers as well. And it's just great. And you can run multiple simulations. You can log in and search simulations by name, or you can just save each simulation code and pull each one up, depending on, maybe you're like, well, what if I spent more than I thought I was going to spend? So you run a second simulation, you can just, play with the numbers a little bit. But the simulator is incredible. You go through, you put your deposits in, put your expenses in, things like that. And then it's going to tell you, kind of like we saw in that previous slide, it's going to tell you how much you would save as far as interest and how quickly you'll pay your house off based on that information. So anyway, that's pretty much it at this point. Wanted to go over that as quickly as possible. If you have any questions, feel free to reach out to me at any point in time. You can do the loan application at timdial.com and we'll get you set up to refinance into this program. And that's pretty much it. I look forward to talking to you as soon as possible and getting you on this program because it's incredible. And I think you're going to love getting your mortgage paid off in half the time or less. Thanks.